In the 1700s, Benjamin Franklin said the only thing you can count on is death and taxes. Well, the complexity of our tax structure is just as certain. Joining us today to help break down the tax shift and the impact of the One Big Beautiful Bill Act are tax experts from Eide Bailly, Joe Kirsten, Russell Rice, and Debbie Potter. Please help me welcome them to the stage.
All right. Well, thanks a lot, and it's great to be here again. It's a great group, and I've been looking forward to seeing you for a long time. So we'll get started right in. I think there's a lot that's happened in the last couple of years, believe it or not, and we'll get going on that. First, we have to give the official disclaimer. You have 1 second to read that. A lot has happened since 2024, and I think that the biggest watchword is that we've added a lot of stability for business tax planning since 2024. And a lot of that comes from the HR 1 that was signed on July 4th that has made permanent a lot of things that were temporary. It has restored some deductions that had gone away, and it provides some stability. But it also adds some uncertainty because it adds its own temporary provisions and adds some complications to the lives of employers and as far as reporting. So we'll go through all that and cover it. The most important thing from, I think, the perspective of most taxpayers, most business taxpayers, were the big 3 business provisions. 3 provisions that had been enacted in the 2017 Tax Act had expired. A lot of people had never expected them to expire, but because of the way Congress works, they had done so. One was the current deduction for domestic research costs. One was 100% bonus depreciation. And one was the increased cap on interest deductions. These were the big 3 that were key to business tax planning. The loss of current research deductions was a real problem, especially for research-heavy businesses, for software industry, and that caused a lot of issues going forward. Now, under the OBBA, the domestic R&D costs can be immediately expensed rather than amortized over 5 years. Unfortunately for some taxpayers, foreign R&D costs remain subject to 15-year amortization. Unlike the last time this was done, this is a permanent extension, so you don't have to worry about in 5 years having to start capitalizing research expenses again unless Congress does something else. Taxpayers who want to amortize their R&D costs for whatever reason, because they have loss carryforwards, for example, can still do that. An important provision is that taxpayers are allowed to accelerate recovery of the costs that they had amortized up until now. So if you've been amortizing and capitalizing R&D costs 2022, 2023, 2024, you can accelerate the recovery of those on 2025 returns. Small businesses, and by small, that's average gross receipts of 31 million or less over the prior 3 years, can retroactively expense 2022 to 2024 R&D costs, which means that they can amend their returns, file for refunds, and so on. Whether they want to do it at this point is a matter of, well, how big is that? Is it worth the expense of doing that? Do we have time to do that? If you're a calendar year taxpayer and you didn't extend your return, you need to get that done by March 15th of 2026 for the first year of that. And so that's something to keep an eye on as you go forward. and it's not mandatory to have to do that. 100% bonus depreciation. For a lot of taxpayers, this is the big thing. Basically, it's 179, but better, and it counts for everything. You can generate losses with bonus depreciation, which you can't do with 179. And this is permanent, and it's retroactive to items placed in service after January 19th of 2025. So for January 2025 additions, you're going to need to take a good hard look at when those things were ready to go on the floor. It allows immediate expensing, and unlike the last bonus depreciation provision that was enacted in 2017, this is permanent, or at least as permanent as anything gets in Congress until Congress decides to do something else. As sort of a bonus to that, there is now a new manufacturing facility deduction. And this goes beyond bonus depreciation. This will allow, in effect, current deduction of business real estate, not land, but buildings, that would otherwise have to be a 27 or 31 year property. Allows 100% first-year expensing for non-residential real property used in manufacturing, production, or refining. Important thing for people who are building new manufacturing facilities. This one is a temporary provision. Has to be property constructed after January 19th of last year and before January 1st of 2029. So you've got a relatively narrow window to get this. It's elective, and it excludes property uses for offices, administration, sales, research, and other non-production functions. Now, that's obviously a complication that, in my own view, shouldn't be there. Office, business, manufacturing facility doesn't administer itself. It doesn't sell itself. You have to have offices to do that. That's all part of the process. But you have to separate those functions, and you can only deduct the actual manufacturing piece. And it's also subject to recapture. If it ceases qualified use within 10 years, then you have to take that back into income. So a lot going on there, a lot to think about. Finally, 163J, that's the deduction for interest expense for business costs. As originally enacted by the 2017 Act, this would provide for a limitation at 50% it would limit the deduction of business interest to 50% of EBITDA. And EBITDA is earnings before interest, depreciation, taxes, and amortization. That was biting a lot of people when that was fully phased in, and so now that base is earnings before interest and taxes, so you don't have to take into account depreciation. Very beneficial for a lot of people. There was a lot of other things going on in this act, though, and we'll cover some of the key things. A lot of taxpayers, a lot of business taxpayers are, probably most of them are pass-through entities, S corporations, partnerships, LLCs. And for them, the individual rate and the individual provisions are the most important part. And this has permanently lowered the individual tax rates. The individual tax rates were slated to go up this year, absent action by Congress. Now they are permanently set with a 37% top individual rate. Also provided an increased standard deduction. And One thing that kind of goes the other way is starting in 2026 is a new floor on charitable deductions. You won't be able to itemize charitable deductions until they reach 0.5% of your modified adjusted gross income, which for most of the people here would be the same as adjusted gross income. That's partially made up for by an above-the-line $1,000 deduction that will be allowed for charity. Another provision is limitation on the benefit of most itemized deductions to 35%. So if you're in the top bracket, the 37% tip bracket, which is the case for a lot of people who have their businesses in successful S corporations, you're only going to get a 35% benefit from your charitable contributions, for example, rather than a 37% benefit. A campaign promise was that there would eliminate taxes on Social Security. That didn't happen. Instead, there's a new $6,000 standard deduction for seniors that phases out as income exceeds $75,000 for single filers and $150,000 for joint filers.
Joe, Montana is going to allow that as well.
Okay. And that's going to be a state-by-state issue.
Yeah, but Montana is going to allow that additional $6,000. So you get it on both the federal and the Montana return if you qualify.
Another key business provision was the permanent extension of the QBI deduction, Section 199A. It increased the taxable income levels before it's subject to a phase out based on wages or depreciable property. There's a new minimum deduction for active businesses with at least $1,000 of QBI. These changes are effective starting in 2026. Now comes a couple provisions that have gotten a lot of coverage. There's a new deduction for qualified overtime. And this is going to confuse a lot of people, a lot of employees. It only applies to Fair Labor Standards Act overtime, which is the half provision part of time and a half. If you pay double time for holiday or Sunday or something like that, that deduction will only be half. That's a deduction that is taken by the employee. So it shows up on their W-2, and then they have to file and compute a deduction. At high, it's limited to $12,500 for single taxpayers, $25,000 for joint filers, and it phases out at high income levels. So something to watch out for. Where this becomes an issue is for employers, of course, is how do you report this? And how do you compute the amount that has to go in? And so remember that it's capped at the half part of time and a half. And so if you have other overtime provisions, either through a collective bargaining agreement or through a company policy, you have to be able to break those items out. And so your systems have to be adjusted for that. Then there's a new deduction for qualified tips. Again, this is an employee deduction. The employee will have to compute that on their tax returns and deduct it there. And this kind of is going to present a quandary for some employees because tips, especially cash tips, are on the notorious non-compliance area. They've generally just left them off. And so, how many people are going to include it and back it off, especially since the deduction does not apply to self-employment tax if you're getting your tips as a self-employed person, so there are a lot of issues there. Employers will have to withhold payroll taxes as they usually do, and the deduction is capped at $12,500. There are a lot of issues there. Your qualified tips have to be voluntary. So if you work at a restaurant where they add a 20% service charge to the thing and then add that to the compensation, that does not qualify. So it has to be voluntary. You have to be able to at least opt out. And it can't be for pornographic activity under regulations proposed by the IRS. Now, you know, some of us enjoy watching tax shows. I don't think that qualifies, but seriously, though, there are a lot of issues around that. One, that's not in the statute. That was something they said, oh, you know, OnlyFans qualifies. We didn't really want to do that, and so they've sort of thrown that into the rules, whether that, you know, sticks under either the Supreme Court's Loper-Bright ruling or under general First Amendment law. I don't know. But there are other reasons that it might not qualify. Because this was enacted kind of late and they didn't really think this through as thoroughly as maybe they should have, there are no penalties for omitting overtime reporting or tip reporting from 2025 information returns. So all of the updating of employer reporting is going to be a 2026 problem. IRS issued a list of qualifying occupations. Unfortunately, that list was occupations that, quote, traditionally have received tips. There's also a provision in the tip rules that says if you're a specified service trade or business, you don't qualify. You might be familiar with that specified service trade or business thing from Section 199A, which has a similar, well, basically the same rule. And basically it says that, you know, accountants, lawyers, bankers, restaurants don't get to take Section 199A. And, you know, or services that are based on the reputation of the business, performance doesn't qualify. And yet this list of occupations includes a lot of things that would be specified service trade or businesses, including internet influencers and performers. And so that's something that you'll have to watch. Another issue that's important to a lot of people with pass-through businesses is the increase in the deduction for state and local taxes to $40,000 max. No change was made to the so-called PTET, pass-through entity tax optional PTET rules, so those are still there, and I think a lot of people will continue to prefer the PTET option as those do not change. Remember, though, that those rules are subject to a lot of questions as far as election, what year you can deduct it, whether it's based on when you pay cash, if you're an accrual basis taxpayer, when you get to accrue it. There are a lot of issues as far as S corporation allocations and partnership allocations, because the beneficiaries of that, if you have a multi-state owner group, it can get very messy in a hurry. So, but those questions were there before. For those of you who are in the startup area, a big change was an enhancement of the qualified small business stock deduction. This is a exclusion of capital gains on the sale of qualifying stock in a qualifying business. And it's up to 100% exclusion of capital gains, and it had been a $10 million cap, now it's a $15 million cap. And larger businesses can qualify. It's a C corporation thing. So it sort of plays into the whole choice of entity thing. So what has changed in choice of entity? Really, it kind of balances out the permanent 199A deduction and the increased SALT cap favor pass-through entities, but the enhanced qualified small business stock deduction is also good for C corporations and might be something that is very attractive if you have investors that don't want to have a pass-through entity. A lot of nonprofits, a lot of pension funds, a lot of hedge funds don't want to be getting K1s. And so this might come into play in choice of entity of startups. There were changes for 1099 reporting. It was going to go to a $600 threshold for so-called 1099K independent contractor reporting. That has permanently been boosted back up to $20,000. Rural opportunity zones, those have been enhanced quite a bit, and for certain census tracts, if you can get somebody to invest in that census tract, that means they can defer a lot of capital gains, they can get a basis step up, and they can get a permanent exclusion of additional capital gains on that investment. So that is a complicated area, but if you are if you're a taxpayer that has large capital gains and you'd like to do something with it besides going on vacation, you want to invest in a business, this might be an attractive thing. It might also be helpful for getting financing for certain, particularly equity financing in a lot of parts of the state. And then for business owners, another key item was a permanent fix to estate tax. The estate tax lifetime exclusion was slated to be reduced by half for 2026. That has been changed, and for 2025, it's just under 14 million, and now it's going to be a larger number going forward, and it's going to be enhanced, indexed for inflation, greatly simplifying estate planning for a lot of business owners. Won't spend a lot of time on the alternative energy credits because of time considerations, but those have been greatly reduced. I'll add that one thing to keep in mind as you enter this year is start your year-end planning now. Contribute to your IRAs now, contribute to your 401ks if you can. You're a lot better off doing it now than next April 15th, which is the deadline, because then your money is working tax-free for an extra 15 and a half months, so get to work. Finally, big picture tax policy. This year we're not going to see a lot of tax legislation, if any. If anything we see, it's going to be pretty minor. What we're going to see more in the tax area is legislation putting into force a lot of the things that were enacted in OBBA, answering unanswered questions. And then the other big thing is going to be the tariff Supreme Court ruling, which will affect a lot of the businesses, as was discussed this morning. Long term, it's hard to say what's going to happen. We have big deficits that are going to be going on for quite a while unless something drastic changes. And most of that is baked in with Medicare, Social Security, and other so-called permanent programs. That's it's a big share of the budget, and it's an even larger share of the expected growth in the budget. The Social Security Trust Fund is scheduled to go into red in just a few years, in which case, under current law, that's going to mean a 20% across the board cut in Social Security benefits. That's unlikely to be allowed, but then that's going to require a lot of other things to happen, including perhaps tax increases long term. So we already have a very highly progressive system, so it's not just going to be likely the rich, but since everybody else is going to have to pay, the rich are probably going to get a bite out of that. So with that, I've already taken too much of your time, and so I will turn it over to Russell.
Hi, everyone. My name's Debbie Potter. I'm the market leader for the Billings office and the state of Montana. If you can take a moment and help me thank Joe, he'll be retiring at the end of our fiscal year at the end of April, so this will be our last time having him present. So thank you, Joe. So Russell and I are going to touch base on a few of Montana-specific items. Obviously, it was a very successful legislative session. During the lawmakers' 85 days at work, 1759 bills were introduced, and of those 1,700 bills, 950 were signed into law. Republicans controlled with a 58-42 House majority and a 32-18 Senate majority, as well as the governor's office. Republican leaders touted work advancing bills to give Montana's residential property tax relief. We know that's a hot topic. Address the high cost of housing and adjust regulations around energy development. The Democrats cited success moving forward bills addressing education and housing funding. The legislature wrapped up the 25 session, having passed a $16.6 billion two-year balanced budget. And the budget include continuing funding for the state's expanded Medicaid program and property tax relief. So busy session last year. A couple of the topics we're going to cover are some income tax changes. There wasn't a significant amount of just income tax changes last legislature. It was probably from the prior one back in 22. Whichever one that was. And then the Montana property tax change is obviously the hot topic. So for income tax purposes, the individual tax rate will be reducing again in 26, down from 5.9 to 5.65. And for 27, it will drop down to 5.4. And I know we have a lot of favorite bills that might have passed in legislature. This might be mine, because rarely do we get to have a reduced income tax, so I'll take the win on that. And then just to reiterate, as Joe was going through some of those changes from a federal perspective, and Russell made an extra point to note that seniors will also be receiving that additional $6,000 deduction on your Montana return, in addition to the standard deduction that you might take. So that's very promising, and I think will be very helpful going into the 26 tax year. After that, I will turn it over to Russell to talk about our favorite topics since the legislature closed.
Thanks, Debbie. Yes, property taxes has been a big hot topic. I remember we were here 2 years ago when they were talking about the upcoming 2025 session, and that they anticipated that property taxes would be one of the hot button issues. So obviously, as residents of Montana, we all know that over the last few years that the prices of property have gone up rapidly, and so obviously with the increase in value of those properties, and obviously the property tax assessments also had gone up and started to creep up. So that was a major, as I mentioned, a major sticking point for many folks, a hot button topic, and it was one that was addressed by the legislature. And so Obviously some people like the outcome, other people don't necessarily like it. We've heard from many of our clients that have second homes or vacation homes, or some clients that are non-residents that essentially they have a vacation home here, that the increase in their property taxes has been very substantial, eye-poppingly substantial, to where they're like, oh my gosh, how is this going to actually work? And so, but for many, myself included, when I got my recent property tax assessment, I was like, all right, mine went down on my house. So it affects everyone a little bit differently. I guess one thing to just understand and know as a second bullet point there is that, the property tax, the amount that's collected really didn't change. You just kind of shifted it from area to area. So as part of these two bills, there's really two bills that were passed: House Bill 231 and Senate Bill 542. And I'm not a parliamentarian by any means, but as I went through there and kind of looked at them, House Bill 231 seemed more procedural in nature. And so many of the changes, and what I'm going to talk about most, is through Senate Bill 542. But as a result of these two bills, the legislature revised the property tax rates for residential, commercial, and agricultural properties. And it did three main things. One, it created a $400 property tax rebate, similar to ones that happened in 23 and 24. Those were larger amounts. They were $675. This one was $400. And then the second thing that it did, it created a one-year transitional year property tax structure for 2025 to kind of bridge the gap and allow the Department of Revenue adequate time to implement the permanent structure that will be implemented in 2026. And so obviously on the left-hand column there, you'll see the 2025 bullet points, and then on the right-hand side, the 2026. Obviously 2025 has come and gone, so I'm going to concentrate mostly on the 2026 portion there. But for principal residents, these bills resulted in a tax rate reduction for many folks on their principal residence. To counteract that, for non-principal residences, either vacation homes, cabins, also short-term rentals like VRBO, those types of rentals, there's a higher flat rate of 1.9%. That's where many, as I mentioned from our client base that's where many of the increases have really happened. Commercial property and then agricultural land as well. So I'm going to actually, oops, what did I do? I turned it off somehow.
Go backwards.
Go backwards? Oh, all right. Sorry about that. Nope, that's where I wanted to go anyway. So 2026. So right there on the left, you can see from the residential property, primary residence and long-term rentals, and this is typically defined as those that have been for tenants over 28 days and for 7 months out of the year, qualify as long-term rentals. They qualify for the reduced rate. Qualified agricultural properties, 1.35%, and then non-principal residences, as I mentioned, your cabins, your vacation homes, your second homes, and then the short-term rental VRBOs come in at that flat rate at 1.9. I know the next session is also a deeper dive into property taxes, so we don't go as much here. Just kind of wanted to skim over the surface and allow a few minutes for question and answer. But you can see there from commercial property and agricultural land. And as I got into the details, a lot of the calculations are based off of the median value as calculated by, I don't know if the Department of Commerce or who does that, but they anticipate for 2025, I think the median value is like $387,000. And for 2026, the median value, I think they estimated, obviously hasn't been calculated yet, but as you can see there in the bottom right of that green column there is about $395,000. So a lot of the calculations are based off of that median value. And then just to finish up here is, in order to qualify for those reduced rates, either on your principal residence or on a long-term rental, if you do have a long-term rental where you have a long-term tenant in there, is that you have to qualify. So for many folks, if you've lived in your house for a long time and you got the $400 property tax credit, you applied for it under that, then you're automatically grandfathered in, you're automatically qualified under that. But if you move during the year, bought a new house, or if you do have long-term rentals, then you actually have to go to the property tax website through the Department of Revenue. And there's actually a couple of different tools there that are very handy, is that you can look up, you can get your geo code, which is like 13 digits. You can actually look it up to see if it's qualified with the Department of Revenue, either for your principal residence, or you can also put in information, fill out the application for the long-term rental exclusion. So that runs now, that portal is now open, and it runs all the way until March 1st of this year. So that's one thing. The Department of Revenue does have a very good site. Their property tax site hub is very good. A couple of different tables kind of outlining the differences that happen between 24, 25, and 26. Also walks through a lot of these things. You have those tools there to look it up to make sure that you're qualified. And then also if you want to do the long-term rental exclusion or exception, you get that application is there and you can fill that out as well. So just a reminder for any of those. I know in our office, we were able to, through our software, identify those folks that had rentals reported on their tax returns. So we've sent out emails, tried to give them a call to make sure that they do fill out the application. I think you have to put in a little bit of kind of like a profit and loss where you anticipate what your income is going to be per month. And then obviously similar as you have with the property tax rebates is that you have to certify that, the tenant was in there for 28 days and 7 months and, those types of things. Similar certification process that you had for the property tax rebates we've had for the last 3 years. So just a reminder for that. Otherwise, I don't know if there's an appeal process, honestly. Otherwise, you may just have to live with the higher rates for an entire year, and I'm guessing if you do it once, you're not going to forget it a second year. But just a quick reminder that is open for another, 2 months, the rest of January and February as well. So I know we went through those very quickly. We wanted to make sure we had a few minutes for question and answer if there is any. And so we will, I don't know if there's a gentleman over here with the microphone.
Charles, I can probably speak loud enough.
Sorry, can you speak up, sir?
Thank you for asking. So the long-term resident, does that qualify for multi-family housing long-term residents as well, or just single-family residents?
I think the single-family residence has one, and the multifamily has a different flat rate, if I understand correctly. I think the next group would definitively be able to answer that question, but I believe that it's 2 separate rates.
Thank you.
Yeah. And the thing, as it was mentioned before, is that obviously your local jurisdiction and the mill rates and all that may affect everyone a little bit differently. So if you're in Yellowstone County or Lewis and Clark County, even those reduced rates, that this will affect everyone a little bit differently. And then I think in Billings in Yellowstone County, now they're trying to determine whether or not there's a educational school district budget shortfall as a result of some of these things. So obviously it's widespread effect, good or bad, on many different levels. All right, clear as mud. We were able to get out a tax seminar with one question. Well, we're around, so please, if you do have any other questions, we're happy to discuss, happy to answer whatever we can, and we appreciate the invitation and the opportunity to be here once again. Thank you very much.
Well, I know for me, clearly it's not very clear. But we are appreciative that they took time to walk through that and gave us a little bit more insight, but without question, our accountants are going to earn their fees this year.